Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us today on this beautiful Tuesday morning in the fall 2022 term. Wanted to quickly call your attention to where we are in the classroom and also to encourage you to follow along. We are in Module 1, Week 2, and today we'll be covering Chapters 3 and 4. And you have an accompanying Chapter 3 quiz that is due this Sunday night, and a Chapter 4 discussion board, which is also due this Sunday night. In the discussion board, I'm looking for full paragraphs and responses to your classmates, also in full paragraphs. And when you can, please also include any citations and references. It's a very important concept. There are 2 attempts on all quizzes and homework assignments in this course, so and I'll accept the higher of the 2 scores, just as a preface. For those of you who would like to follow along, please open up your Chapter 3 PowerPoint, and we'll talk about the accounting cycle. So last week, and this kind of builds on last week, we talked briefly about the accounting cycle, and we talked about debits and credits and transactions and how those transactions are recorded and how they affect the, it's doing it again. This must be a WebEx thing. And how they affect the accounting equation. You know, we talked about how the accounting equation always stays in balance, right? And so everything that you learned last week, this week builds on that information. And I'll show you how it's all connected. Because oftentimes, when we're learning accounting, what was that noise? When we're learning accounting, we need to really understand why we're learning, right? And that's what it boils down to. And so I'll do my best to use examples and explanations as to why we're learning this stuff and why it's important to us. So we're going to be going through the accounting cycle, and we're going to be talking about the steps in the accounting cycle, which is really the foundation of our transactions and how everything gets closed out. So in accounting, we talk about accounting periods. The word period simply means amount of time. Okay, it's the amount of time. And when we talk about this, when we talk about this concept of time, we're talking about how the financial statements, income statement, balance sheet, statement of cash flow, statement of retained earnings, are displayed. This can be done monthly, quarterly, semi-annual, or annual. The monthly income statement shows us the revenue, income, and expenses for each month, for the month. Right? So right now we're in August. We're just finishing August tomorrow. Tomorrow's the 31st. And when we finish August, I'll be able to see my income statement for the month of August. And on that monthly report, it will show me all of my revenue and expenses for the month of August. Now, with that information, I can compare the month of August to last August, which will tell me how well I did this August compared to last August. Now also, I can look at the information quarterly. When I report my information to investors, they're interested in knowing how well I did for the quarter. A quarter represents 3 months of information. January, February, March, that's quarter one. April, May, June, that's quarter two. July, August, September, quarter three. October, November, December, quarter four. This quarterly information is useful for investors, for management, for the government, because we can make decisions on the quarterly information. And the quarterly information, I can show the income statement for the quarter, the balance sheet for the quarter, statement of cash flows for the quarter, and that type of information helps me to, again, make decisions. If I'm an investor, I look at the quarterly data and make investment decisions based off of that information. And that's why, for those of you who follow business news, you'll notice that large companies that are publicly traded report their financial statements every quarter. It's like, oh, they're up this quarter, they're down that quarter. And that's where that information comes from. Okay, income statement, balance sheet statement, of cash flows for the quarter. The financial statements, income statement, balance sheet statement, of cash flows, can also be reported in a semi-annual format, every 6 months. And that information is useful for management in order to understand the direction and the trends for the company. And then, of course, the information is always reported annually. At the end of the year, end of 12 months, end of the business year, end of 12 months, I can determine how well the company performed throughout the 12 months, throughout the year. That's the annual report. The annual financial statements, income statement, balance sheet, statement of cash flows, statement of retained earnings, tell us how well the company performed for the entire business year. Now, you heard me say the word business year. It's the fiscal year for the business. What you need to know is not every business follows the calendar year for reporting, because not every business started in January. For example, my business, when I had my business, I started that business on April 1st. And so, because I started the business in April, my fiscal year ran from April 1 to March 31st. That was my fiscal year. That was my 12 months. Now, of course, I still needed to pay taxes when they were due. And so I would record the taxes for the 9 months for that particular year, and then I would do the full 12 the following. So when it comes to taxation, it's different, right? But the point of me telling you the story is the business fiscal year is different than the calendar year. Sometimes they're the same, but for the most part, they're different. So that's how reporting the accounting period works. So when you hear accounting period, think it can be reported in a month, a quarter, semi-annual, or annual. In most cases, for the purposes of this course, we'll be talking from a monthly perspective or an annual perspective. This part is so important, okay? So I need you to understand that there are two reporting methods for accounting. And the company selects one of the two. They cannot use both. Okay? They cannot use both. The company selects one of the two reporting methods. One is called the accrual base of accounting, and the other is called the cash base for accounting. Now, here's the difference. In accrual-based accounting, I record the revenue when the goods or the service has been delivered, and I record expenses when they've been incurred. Okay. A lot of businesses use the accrual method. And the reason for that is because under US GAAP, the generally accepted accounting principles that we talked about last week, are required for companies that report their financial statements to the IRS, which they have to every year. So, having said that, accrual base is always preferred. However, some companies will use the cash-based accounting system. The cash-based accounting system records revenue when the cash is received, not when we deliver the product or the service, when the cash is received. And some companies using the cash-based system will also record expenses when the cash is paid. The two systems are very different from each other because of the way that revenue is recorded and expenses are recorded. So if you see a question on a quiz, for example, that talks about the differences between the two, the best way to think about it is that when you hear the word accrual, it simply means that I record the revenue when it's earned, and I record the expenses when they happened. Accrual. I've accrued the revenue. I've accrued the expenses. That's accrual based. In the accrual based system, we also use accounts like accounts receivable and accounts payable. Accounts receivable is when I've made the sale to the customer, I provided the good or the service to the customer, but they have not yet paid me. That creates what's called an accounts receivable. I, the company, expect to receive that cash from the customer based off of the sale. Accounts receivable. Accounts payable is when I, the company, have received a bill for whatever, utilities, rent, whatever. I received the bill, but I have not yet paid it. That's called an accounts payable. I record the expense when it was incurred. Yep. But I have not yet paid it. I accrued the expense. So that's accrual-based accounting. Cash-based accounting, I record the revenue when I received it. When I received the cash. Example, Restaurant businesses typically use cash-based accounting. The reason why is because they receive cash from their customer at the end of their visit. When you ask the waiter for the check and you pay, that's when the restaurant records the revenue. Okay? Simple. They also pay their bills using a check in cash. And they record the expense when they paid it. That's cash-based accounting. We'll go into deeper detail, but that's the general concept. And so for those of you in the class that own your own business or will own your own business or you're thinking about owning a business, keep in mind that you have to select one of the two. You can only stick with one or the two or the other. I always recommend accrual-based accounting because that is what is generally accepted accounting principles here in the United States. Cash-based accounting is easier, but accrual-based accounting is what's generally accepted. And the way I want you to also think about how to select one or the other is think about how your customer pays. If your customer is going to pay you later, use accrual-based accounting. If your customer is going to pay you right now with cash, use cash-based accounting. So the majority of businesses, again, use accrual-based accounting. Some businesses, like a restaurant or a food truck or other cash-based businesses, nail salons, barber shops, etc. Those types of businesses, because they're heavily cash-based, they use cash-based accounting. So again, when you're selecting one of the two, think about your customer. How are they going to pay you normally? And that's how you determine which one is best for you. But I want you to think about the difference. Okay. So using accrual-based accounting, the expense has to matching principle, talked about that last week, when it was incurred. So here's an example. Insurance. Oh, insurance is such a good example. Some companies and people pay their insurance in advance. Okay? For example, I like to pay my car insurance in one payment, and it covers the whole 12 months. One payment, because I get a discount, right? But one payment covers the whole 12 months. Okay? Now, when I pay that insurance for the whole 12 months, I'm using the accrual-based accounting system. Now, what happens is I have to break out the consumption of that 12 months. Now, here's what I mean by consumption. Out of the $2,400, I'm going to consume an equal amount every month. And I record it in that month because that's the month I'm consuming that payment that's when I'm using the insurance. So let's take a look at this example. Our company paid $2,400 for 24 months of insurance starting on December 2019. So in December 2019, we decided, hey, you know what? We're going to pay for a full 2 years of insurance. Great. Yeah, we get a discount doing that. Yeah, absolutely. So here's how we record it. December, $100. Every month, $100 for the 24 months. Okay? The reason why we record it this way is because according to the accrual-based accounting system, I need to match the expense with when it is incurred, according to the matching principle, right? So I spread $100, I allocate $100 of insurance expense every month for a full 24 months. Any questions so far, or is this making sense? That makes sense, right?
Yes.
Yes? Okay.
Yes, sir.
Thank you. Okay, at least it makes some sense. We're getting there. Okay, so that's accrual based. You see, I allocated evenly the insurance for the 24 months. That's accrual based accounting. In cash based accounting, I recognize the entire $2,400 expense for insurance in the month of December 2019. Why? Because that's when I paid it. I paid the cash. According to cash-based accounting, I recognize the expense when it's paid. Okay? So think about the implication here. Think about the difference. Under accrual-based accounting, I spread it $100 every month for 24 months. Under cash-based accounting, $2,400 in 1 month. Think about that, what that does for your report, for your income statement. Your income statement looks all hunky-dory under the accrual accounting-based system. I see every month, $100, $100, $100. The income statement under the cash-based system shows a $2,400 hit in the month of December. Yeah, so what that does is it makes it look like you had this massive expense in the month of December 2019. And then the other months, nothing, right? So that's the difference in reporting. If you use the accrual-based system, it's even. You know, it's logical. Or you recognize the expense when it's incurred. But in the cash-based system, we recognize the expense when it's paid. So that's the primary difference between the two. Recognizing revenue is so important. That's when we recognize the sale. Okay. Last week, we talked about this briefly. This is the revenue recognition principle. Okay. According to the revenue recognition principle, we record revenue when we have delivered the good or the service to the customer at the expected amount we expect to receive from the customer. That's the revenue recognition principle. Remember, we gave the example of the lawn mowing service. Let's say we have a lawn mowing company, okay? And we have a couple of customers down the street and we mow their lawns. The customers might pay us up front for the month. They'll write us a check on the first of the month for the lawn service for that month. But according to the accrual-based system, I cannot yet recognize that revenue. Why? Can anyone tell me why? Who can tell me
Because you
why?
haven't received yet.
Yeah, because I haven't, you're right. I haven't done it yet. I didn't mow the lawn yet. So if your customer pays you before you perform the good or the service, we call that unearned revenue, and that's a liability. It's a liability account, unearned revenue. But after you mow the lawn for the month, then you can move it using the adjusting entry. I'll show you what those look like soon. From unearned revenue to revenue. So it goes from unearned revenue to revenue after you've performed the good or the service. Correct. Very well done. That's the concept of the revenue recognition principle under the accrual-based system. Under the cash-based system, we recognize the revenue when we receive the cash. That's the difference between the two systems, yeah? Expenses. Expenses, as you know, that those are the day-to-day operating expenses for the business. It's like utility bills, okay, supplies for the office, rent for the copier machine. You got to pay your employees' wages. You got insurance. You got so many different expenses, right? Tons and tons of expenses. When we recognize expenses, again, according to the matching principle, under the accrual-based system, I must match my expense with the associated revenue. What I mean by that is, I need to say this expense occurred in this month that's related to the sales I made for that month. Example, I received recently my electric bill for the month of July, and I paid it in August. Which month do I record my electric bill if I'm using accrual-based accounting? Which month do I record my electric bill? The bill is for the month of July. I received it in August. I paid it in August. But which month do I record the electric expense? July or August? Who can tell me? Which month?
Ask one more time. Can you ask one more time?
Sure. I received my electric bill recently, and it's for the month of July. Okay, so the electric I used in the month of July. I received my bill in August. I recently paid it. According to the accrual-based accounting system, do I record the electric expense in July or August?
August.
So close, but no, it's July. And here's why. Remember, I used the electric in July. I received the bill in August because, they're behind. They're like 2 weeks behind, yes? I consumed the electric in July. I received the bill in August, and I paid it in August. According to the accrual-based accounting system, I must record the expense when it's used, when the electric was used. So I record the electric consumption, the electric bill, in July. And the reason for that is because of the matching principle. It tells me that I must match the expense, the electric expense, during the time it was used that matches when I receive the revenue. So, in other words, I need my lights on in order to make money, right? I need electric to make money. And I made money in July, and I used electric in July. So therefore, the electric bill belongs in July. Does that make sense?
That makes a lot of sense now. Thank you so much.
You're very welcome. Yes, I know it can be confusing, especially when we're learning about two different systems. So throughout most of this course, everything's going to be based on the accrual system. That's why I want you to understand the difference between the two, but I also want you to understand the concept behind the accrual system and how it works. Because, and again, most companies use the accrual-based accounting system, which is why it's important for you, but also it's used for the generally accepted accounting principles in the United States, and it follows when we need to pay our taxes and things like that. So that's why it's so important. Nick, did you have a question? You're good.
No,
Okay.
my apologies. My apologies.
That's okay. That's all right. I just want to make sure. All right. Okay. Now, in the accrual-based accounting system, we have deferrals and accruals. Accrual simply mean that we accrue over time. Yes, over time. We accrue the revenue or the expense over time. Accrue it. Accruals, we're adding over time. Yes, accrual. And we can do this with certain expenses and certain revenues. Okay. We also can defer. Deferral means we put it off. Deferral means we put it off. Yeah, we wait. Deferral. We can defer revenue and expenses. We can also accrue revenue and expenses only in the accrual-based system. So there's really four different kinds. Deferral of expense, deferral of revenue. Accrual of expense, accrual of revenue. And there's a process that we follow to make adjustments for these deferrals and accruals. We call these adjusting entries. Okay. Now, as you know now, with the accrual-based accounting system, we must match the consumption of things like electric or insurance when it's incurred, when it happens. Yeah, when it happens. If I pay my insurance bill up front for the full year in advance, yeah? So let's say I got my insurance bill, it starts September 1, 2022. It ends August 31, 2023. That's the next 12 months, right? According to the accrual-based accounting system, I need to accrue that expense every month. And so I take the total amount and I divide that by 12 to get me the amount I need to adjust every single month. And I'll show you what this looks like. But there's three steps to making adjusting entries. The first thing we do is we identify the current amount of the balance. And then the second step is we identify what it should equal to. So what I mean by that is sometimes there's going to be a difference. Yep. If I got the bill $2,400 for the 12 months, or let's say it's $1,200 for the 12 months, so it's $100 a month, the balance is not going to be $100. Okay, I've already paid it. I've already paid it up front, so the balance is actually going to be zero. But every month I'm adjusting that total balance downward. My prepaid expense downward. I'm going to show you what this looks like. And then step 3 is to record the entry. So let me show you the adjusting entry process. Here's a good one. Deferred, yes, prepaid insurance. This is what I want to show you. This is a good one. Prepaid expenses. These are called deferred expenses. Let me explain to you. A deferred expense or a prepaid expense means you already paid for it, but it has not yet happened. You paid up front. When you hear prepaid expense or deferred expense, it means you paid already, but it has not yet happened. Okay? A couple of examples of this. Prepaid insurance, prepaid rent, prepaid supplies, or prepaid whatevers. There's a couple of prepayments, yeah? Prepaid insurance, prepaid rent, prepaid taxes sometimes. There's a lot of different. But to make it easy, let's talk about prepaid insurance. Using the example, the company prepaid the insurance for 24 months on December 1, 2019, and it covers a full 24 months starting with December 2019. Okay? Which means it'll end in November 2021. That's 24 months. We paid the entire 24 months up front, which makes it prepaid insurance. Here's the thing with prepaid expenses. Prepaid expenses, those are asset accounts. Now, let me explain to you why. I can already hear you. Dr. B, it says expense. Why is it? Let me explain to you. A prepaid expense is an asset account. And the reason why a prepaid expense is an asset account is because you have a claim to that amount. What I mean by that is you can always go back to the insurance company and be like, hey, listen, I'm going to cancel this policy. They'll refund you. Yes? When you cancel the policy, they refund you what you're prepaid. A prorated amount, usually. But the point is, you have a claim to that amount that you paid. And so that's what makes it an asset. Does that make sense?
Yes.
Awesome.
Yes, sir.
Yes.
Cool.
So quick question. So basically, it's prepaid. So I use it up to a certain point, but even if I don't finish out, I still get the money back. So it's still an asset because I'm
Correct.
using it and I'm still gaining that money back that I previously used for
You
the expense. Correct?
You got it, Nick. Yeah, that's 100% right. So,
Got you. Thank you.
yeah, absolutely. And that's the way to think about it. Anytime that you have a claim to something, meaning you have the right to say, "Hey, I want a refund," that's usually an asset. Because, for example, Nick, let's say that you got car insurance for a year for your car, okay, and you decided, you know what, let's say you're 4 months into it. You know what? I don't like you guys no more. I'm going to go to a different company for my insurance. They have to refund you the remaining balance. Yeah. Uh, because you prepaid them. That's your money that you prepaid that they did not use or you did not use yet. You did not consume that insurance yet. So therefore, you have the right to receive that money back for the amount that was not yet used. Yeah, you're absolutely right on this.
Yes, sir. Thank you.
You're very welcome. So prepaid expenses like prepaid insurance or prepaid rent or prepaid anything is technically an asset because you have the claim to that amount that has not yet been used or consumed. As it's consumed, it becomes an expense, simply an expense. Okay. And so at the end of every month, we record this thing called an adjusting entry, where we simply reverse it. Yep. And I'll show you what that looks like. Here we are. So step one in the adjusting entry process, we identify the balance. Our company paid $2,400 for 24 months of insurance. Okay? So we debit our cash. We debit prepaid insurance to increase the prepaid insurance. Again, asset account. We debit prepaid insurance to increase our prepaid insurance account, asset account. And we credit our cash to reduce our cash, also an asset account. See how it balances on the accounting equation. So that's the journal entry that we made when we paid for the 24-month policy. We debited prepaid insurance and we credited our cash. That was on December 1. Then at the end of December, I used the insurance that I prepaid for the month of December. End of December, I used $100, right? 2,400 divided by 24 months, that's $100 a month. At the end of December, I used $100. Because remember, I paid on December 1. On December 31, I need to record the use of that insurance. So what I do is I am going to debit my insurance expense by $100. And I will credit my prepaid insurance $100. Now what that does is it increases the expense. When you debit an expense, you're increasing the expense. And the reason why is because that's how we recognize that the expense happened. Okay? Remember, it only happens after you've consumed it. So debit insurance expense $100. And we credit the prepaid insurance by $100 to recognize the consumption. Yes? When we credit the prepaid insurance, we're reducing that asset account, yes, by $100. So then it becomes $2,300 at the end of December. And this is what it looks like. And then every month, for 24 months, we make the same exact entry. Debit, insurance expense, credit, prepaid insurance. We do that until the balance of the prepaid insurance reaches zero, which will happen in November 2021. I'm sorry, apparently I got ahead of myself. but that's exactly what happens. So we see that the balance will continually go down every month by $100 until it reaches zero. When it reaches zero, we have to either renew our insurance and do the whole thing again, or whatever. Yeah, but just to show you how it works. But yeah, this shows the consumption. The consumption. And that's what adjusting journal entries do for us, is it represents the consumption of something. Sometimes we also make adjusting journal entries when something went wrong in the past. We need to fix a balance for whatever reason. Sometimes people make mistakes and we have to make an adjusting entry for that. So yes, we made the entry. December 1, we debited Prepaid insurance, we credited cash. December 31, we debited insurance expense and we credited prepaid insurance. That December 31st transaction is called an adjusting journal entry. I'm always getting ahead of myself. I need to show the whole slide first. Okay. Nick.
It's considered an adjusted journal entry once you have finished out the term of the 24 months. That's when you adjust it because that's when it's completed, correct?
No, so we actually make the adjusting journal entry every month because we have to recognize the consumption every month. That's how we increase the expense.
Got you. Could we do some more examples of that
Yeah,
soon, if possible?
absolutely. And this is our next example. Actually, this one's about supplies.
Yes, sir. Thank you.
Yeah, absolutely. Excellent question. So sometimes companies will purchase supplies to be used in advance. So in this example, we purchased $9,720 worth of supplies in the month of December. So we got all the supplies sitting here in the month of December. Now, there's a good chance we're not going to use all the supplies in December. We purchase it in advance to be used later on throughout the year or whatever. And it's supplies is not always consistent. Here's how I want you to think of this. Let's say you own a bakery, okay, a bakery. And at your bakery, you purchase a lot of baking supplies. Yes, a lot of ingredients, a lot of parchment paper, and whatever else you need for baking. The supplies that you're going to use up. And so you made a big purchase in December. You're like, you know what? I'm going to get ahead of the game. Let me purchase all my ingredients in December for the year or for a couple of months or whatever. So we purchased $9,720 worth of supplies in December. So we debit our supplies account, 9720. The supplies account is also an asset account. Remember, the supplies we use to generate revenue, sales, is an asset. If you use something in the company to help you to generate sales, it's an asset. So here's how it looks. Throughout a month, we'll say, I used $1,050 of the supplies. So during that month that I used it, or during that year that I used it, I can make the adjusting journal entry. We make the adjusting journal entry when it is consumed. Okay, for the month or the year that is consumed. Certain prepaid expenses, like insurance, we need to recognize that expense every month because it's consumed on a monthly basis. For something like supplies, we don't always know when it's going to be consumed. It could all be consumed in 1 month. It could all be consumed throughout the year, sporadically, right, based off of sales. So typically with something like supplies, we record the adjusting entry at the end of the year or whenever I do my physical count for inventory. The reason for that, again, the business will use the expenses relatively sporadically. We don't necessarily know. It's not going to be an even amount every month. In the baking world, I got customers coming in, I got customers going out, whenever, right? Some months I might go on vacation, I don't know. The store might be closed, whatever. But what I do know is I'll use the supplies whenever I need them. And so with supplies, we typically record the adjusting journal entry either at the end of the year or whenever we do the physical inventory count during that time period, during that accounting period. Does that make sense?
So
Good.
far, so good.
Okay. All right. All right. Very good. So when in this example, when I did my adjusting entry, I recorded it when I did my physical count. When I said, okay, and this could have been who knows, this could have been in the middle of the year. Okay, it looks like I used about $1,050 worth of supplies here. And so we would debit supplies expense, $1,050, at the time that we did the physical count. And we credit supplies, $1,050. The remaining balance on the balance sheet for supplies would be $8,670. We take the beginning balance minus the ending balance to get the current total balance. Remember, the balance sheet will always show you the remaining balance of whatever it is. Yeah, that's what I call balance sheet. And of course, we used, according to this, we used that $1,050 worth of supplies in 1 month. So, debit supplies expense, credit supplies, that's the adjusting entry. I think that's probably here. Yeah. Yep, here it is. So debit supplies expense, credit supplies, that's the adjusting entry we made. And we can see the effect. Yeah. And remember the accounting equation. We talked about this last week, the accounting equation. Assets equals liabilities plus equity. Assets, supplies. Supplies expense, that's an equity account. Expenses are part of equity. And, well, yes, technically. It's within net income, which is part of equity. But we see the balance. Okay. Has everyone got a good understanding of adjusting entries so far? They require some practice, I know. Uh, in the classroom, there's an area, and I think I showed you. Oh, now it goes away, right? Uh, I think I showed you this before last week. So right here in the classroom, it says practice exercises by topic. Click on that, and you'll probably see one for adjusting entries. Making journal entries, that one's good. That's from last week. I recommend you do that before you jump into the adjusting entries. Here it is. Adjusting for depreciation, adjusting journal entries. Go through those, okay, to help you to understand it. The one thing you'll understand about accounting, the best way to learn about accounting is to try it yourself. Uh, I find that with a lot of things, honestly. I learned by doing, and I think that's very true. Now, of course, it doesn't go away. Okay, there it goes. Okay, now Switching gears slightly, I need to talk to you about depreciation. And this is going to relate to our fixed assets. Last week we briefly talked about fixed assets because we were talking probably about the balance sheet. Assets equals liabilities plus equity. Assets are things that are owned by the company. And we use assets to help us to generate revenue. We also have what's called, under assets, we have what's called fixed assets. Fixed, F-I-X-E-D, fixed. Also known as permanent assets, fixed assets, long-term assets, long-lived assets. They all mean the same thing. Assets, fixed assets. Fixed assets are things like property, plant, and equipment. Property, plant, and equipment. Okay, those are fixed assets. Property, that's the land. That's the land. That's the dirt that the building is on. That's the land. Land is the dirt. Land does not depreciate. Land never, ever, ever, ever depreciates. The soil, the dirt, the earth does not depreciate over time. Okay? Does not depreciate. Why? It cannot lose its useful life. The building I can knock down and put a new one up. The land will be the same. The land never goes away, hopefully. The land never goes away. The land has what we call infinite useful life. So therefore, we never depreciate land. However, we do depreciate plant and equipment. Property does not depreciate. Plant and equipment, they do depreciate over time. Depreciation is the loss of usefulness over time. The loss of usefulness over time. For example, your house that you live in, the building, the structure, it breaks down over time. Okay? Buildings were not designed to be infinite structures. The house you live in, good chance that something goes wrong with it at some point in time. It starts to lose its usefulness. Okay? Now, of course, we will repair it to extend the useful life, but the point that I'm getting to is buildings use their usefulness over time. They lose their useful life. The same can be said with things like automobiles, equipment, anything with a motor or wheels. All those things lose their usefulness over time. Okay, I have yet to see a car since the beginning of cars that is still on the road. I have yet to see a piece of equipment last a long time. Okay, think of like your phone, yeah, your phone, your smartphone. Your smartphone, not so smart. The battery lasts a couple years, maybe, yeah. Then you have to get another one. Yeah. So think of your phone as equipment. Over time, it will use its useful life. It will lose its useful life. And so over time, you need to plan to buy a new one. You replace it. Think of it as equipment. Same thing. It's the same thing. So plant and equipment, buildings, cars, things like that, they lose their usefulness over time. When they lose their usefulness, we call that depreciation. We're depreciating the value of that equipment, buildings, cars, whatever. That's what depreciation means. It's losing its value over time, losing its usefulness. So in accounting, we need to account for that loss of usefulness. And the way we do that is through depreciation. We have a couple of different formulas for depreciation, but I'm going to show you the easiest and most understandable one first. This is called straight line depreciation. Straight line depreciation simply means that I take the original cost of the asset minus its salvage value, and I divide it by its useful life. Let me break this down for you. The original cost of the asset, it's the purchase price, the amount that you paid for it. That's the asset cost. It's the purchase price. It's the cost to get it to you. Yeah? The total cost. That's the asset cost. Minus salvage value. Salvage value simply means what is it worth at the end of its useful life. It might be zero. It might be a few dollars. It might be a few $1,000s. Who knows? Whatever it is, yeah. So it's original cost, total original cost, minus salvage value. What's it worth when it's at the end of its useful life? That's salvage value. Salvage value can also be described as what is it worth when it's no longer useful? That's salvage value. Divided by useful life. The useful life is relatively subjective, okay? However, the IRS has published schedules that tell us what the useful life should be. They tell us how long things typically last. Yeah. There's a report called the Makers Report, MACRS report, and it's published by the IRS every year. And it tells us, on average, how long things will last for. Okay, so I'm going to use an example of a piece of equipment. Let's say you have a screen printing business, screen printing. They make t-shirts, yeah? Let's say you make t-shirts, that's your business, and you have a screen printing machine. That's what puts the logo or whatever on the t-shirt, yes? And it costs you $25,000, this piece of machinery. Okay? According to the IRS, it will last for 5 years. It costs you $25,000. It has a salvage value of 0. So $25,000 asset cost minus 0 is $25,000 divided by 5 years. That means that for every year, for 5 years, we will record a depreciation expense of $5,000. And we do that until the useful life is depleted, reaches 0. Useful life, again, is determined how long it's expected to last. Yeah, that's what useful life means. Useful life ends due to wear and tear, or because it no longer satisfies the needs of the business. That's a cute definition from the book. Yeah. Uh, in reality, in real life, a lot of times we'll just fix stuff and make it last longer. But there's a way of recording that as well. Like, for example, let's say your car. Oh, a wonderful example. Your car. Let's say you bought a car for $25,000. It has a salvage value of 0. It will last you for 5 years. So 25,000 divided by 5 is $5,000 per year. Let's say at the end of year 3, Your transmission dies. Oh, that sucks. That's a big expense, yeah? So your transmission dies end of year 3. Oh, unexpected repair. We call that type of repair an extraordinary repair. Because why? Number one, it's a huge repair. But number two, you replace the transmission, it will technically extend the useful life of the car. And then you make revisions to your depreciation. But just something to think about. Salvage value, as I had mentioned, is what it's worth at the end of its useful life. Also called scrap value, residual value. Yeah. So let's look at an example for straight line depreciation. We purchase a piece of machinery for $26,000, has a useful life of 5 years. The equipment is expected to be worth $8,000 at the end of its 5 years. Well, that's pretty good. We purchased the equipment on December 1, but it's now December 31. So we used it for a month so far. So here's how it works. 26,000 minus, that's the original cost, yeah, minus the 8,000. 8,000 is its salvage value, divided by 5 years. We break the 5 years out into months. So what's that? 5 times 12, right? So that's 60 months. 5 times 12, 60. That's the 60 months. Yeah? So in other words, I can take my 18,000 divided by the 60 months to give me the amount per month. If you needed to break it out that way. It's always best to do it annually, but sometimes you might need to do it monthly, yeah? So 26,000 original cost minus the salvage value of 8,000 gives you net cost 18,000. So we have the 18,000 divided by the 60 months gives us $300 per month. For December 31, I make an adjusting journal entry. I debit depreciation expense, $300, to recognize the depreciation for the 1 month. And I credit an account called accumulated depreciation. Accumulated depreciation is an account, it's called a contra account, that is technically a negative asset account. A negative asset account. Yeah, I already hear you, Dr. B, I've never heard of a negative asset account. A negative asset account is what we call a contra account. And it contras to the asset. It's a way of recognizing the reduction of the useful life of the asset. We never subtract depreciation from the asset. We never subtract it from the asset. We create a contra account to the asset. And I'll show you what this looks like. So we purchased a piece of machinery, December 1, 26,000. At the end of December, we debit depreciation expense, 300, and we credit accumulated depreciation, 300. The accumulated depreciation, as I had said earlier, is a negative asset account. It contras, I don't know if I'm saying that right. It contras the equipment account. So instead of subtracting directly from equipment, we create a negative asset account to contra the equipment. And the reason for this is because, according to the accounting rules, we cannot directly subtract from the equipment account. If we were to do that, it would devalue the equipment, which is much different than depreciating the equipment. So again, the adjusting entry: debit depreciation expense, credit accumulated depreciation. And you see it says dash equipment. The reason why we do this dash equipment in the account name is because a lot of times you have more than one asset. You got buildings, you got equipment, you got vehicles, etc. So you need to designate which asset specifically is this depreciation for. And so here's the effect on the balance sheet. Equipment always remains the same. So it'll always say 26,000 for forever until you take it off the books. But you'll see a negative asset account called accumulated depreciation, which acts as a contra flow account to the equipment account, which represents the depreciated value of the equipment. That's why we call it accumulated depreciation. The word accumulated simply means I'm adding to that account every month, recognizing that depreciation. Yeah. And Nick, I'm sure you'll probably ask the question. Yes, typically we would do this on an annual basis, not necessarily a monthly one. And it really depends, right? Because some companies, they'll file their taxes in certain times. Like earlier, I'd mentioned about how some companies, their 12-month operating cycle or their fiscal cycle is different. So some companies might decide to do it monthly, but normally it's done on an annual basis. Okay. When we make adjusting entries, we're deferring or we're accruing. Yes? I'm going to go through a couple more examples. Unearned revenue. We talked about this one, but I'm going to talk about this one again. Unearned revenue is a liability account. And it happens when we receive payment from our customer before providing the goods or the services. So going back to the lawn service business, my customers paid me in advance. They paid me in the beginning of this month. I have not yet mowed their lawns. Okay. I need to recognize that that is a liability to me. The reason why it's a liability is because when a customer pays you before the good or the service is provided, it is unearned. When it's unearned, it's a liability. The reason why it's a liability is the customer has the right to that cash. They can call you up and say, hey, listen, I don't want you to mow my lawn. I want a refund. That's why it's a liability. Eventually, it'll move out of a liability state and become revenue. Nick, go ahead.
So how does that work? Like, let's say, for example, a gym. Like I used to work for a gym, and then you would they had memberships and so on and so forth. And some people would do memberships. We would get paid before they would pay us before the actual month is, begins, before they have their classes. But some people didn't even use their classes, or they didn't show up, or so on and so forth. How do we gauge that when it comes to services? Like, someone didn't come to the service, or something happened in the service, or something like that, where
Sure.
like the money, we still had the money, but the service was never given.
Yeah, so the company would have recorded that as unearned revenue. So exactly the way that this works is, and it works the same way with the lawn care business concept, right? So customer pays up front, or the client or whoever pays up front for, we'll say, 5 classes, okay? And those 5 classes happen throughout the month. Let's say the customer decides, hey, you know what, I don't want to go to this class, or they don't show up, or whatever the case is, it remains as unearned revenue. It only becomes revenue when the good or the service has been provided. So, um, so to answer your question, in a situation like that, the gym would have recorded, at the time they received the cash from the customer, they would have recorded that as unearned revenue. It's a liability account. And then when the customer attends those classes for that month, or at the end of that month, it becomes revenue. So then that gym would need to make this adjusting entry. They would debit the unearned revenue account, and they would credit revenue.
So how does it work? Like, for example, like, okay, I have a Planet Fitness membership. Sometimes I don't go in a month. Sometimes I work out other places, or I don't go in a month. How does the company go from there when it comes to visits and so on and so forth?
That's a good question. So this comes down to company policy at that point. And what I mean by that is, let's say you have your Planet Fitness account, you have to pay that on the first of every month. Let's say you don't go this month. The company will still call that revenue. And the reason for that is because, according to the company's policy, it will say that you cannot be refunded for time that you did not use. So memberships work a little differently.
So basically, you had the opportunity to do it, but if you did not do it, that's on you.
That's on you, exactly. Yeah, they still provided you the service. You simply did not use the service, right? So that part's on you.
Got you.
Yeah,
Okay.
yeah, and that's how
Thank you,
that
sir.
works. Yeah, exactly.
That
No,
makes a lot of
that's
sense. I appreciate you.
you're welcome. Yeah, no, that's cool. That's a good conversation. I appreciate that. Uh, yeah, whether you come or not, they still provided you the service. You just didn't use it. So that's why the gym would have still recognized that as revenue. So in recognizing this, on the first of the month, the gym would have recorded a debit to on. I'm sorry. They would debit cash because they received the payment from you, and they would credit unearned revenue. When you credit unearned revenue is a liability account. So that would increase it would increase the asset, and it would increase the liability. At the end of the month, whether you went to the gym or not, they would debit unearned revenue to reduce the liability account, and they would credit revenue to increase the equity account. Kind of equation still in balance. But the adjusting entry that they make at the end of each month is debit unearned revenue, credit revenue. That's the adjusting entry. Yeah, good conversation. So there's a couple steps. Uh, First, uh, let's see what do we got going on here. Okay, unearned revenue, yeah. So first we recognize what's going on. The company, the customer paid a 60-day fee in advance for covering what appears to be, what, 2 months. So first we recognize what happened. And when is it happening? Yeah. Step 2, we recognize the time that has passed, and we record the adjusting entries as they occur. That's basically what this tells us. So this is this is the first entry. We receive the payment from the customer, so debit cash, and we credit unearned revenue, whatever unearned revenue account that is, because we have not yet performed the good of the service. And this is the effect on the balance sheet. The $250 represents the revenue being earned as time is passing. Yes. So it becomes earned revenue when we performed the good of the service. And we do that, and again, this is for 2 months, and there's a prorated amount involved here. So that's why we see the difference in the balances. And then at the end, or this is what the adjusting entry looks like when we're earning the revenue. We debit unearned revenue to reduce the liability. We credit earned revenue, or whatever the revenue account is, to recognize the increase of the equity, the revenue. Accounting equation still unbalanced. Okay, so that's revenue. Let's talk about expenses. Sometimes we receive an expense that has both been unpaid and unrecorded. Okay, so we have to record it. We have to recognize the expense. So we debit the expense and we credit the liability. When it's unpaid, it's a liability, right? We have to pay it. It's kind of like when we got our electric bill. We debit the utilities expense and we credit accounts payable. Accounts payable is that account that we goes into when we have not yet paid it. Other examples would include things like wages. I have employees that work for me. They accrue their salaries, their wages over time. I pay them every 2 weeks. So their wages will accrue for those 2 weeks. So let's take a look at a similar example for wages. We have an employee earns $70 per day or $350 for 5 days of work. Salaries are paid every 2 weeks. On December 31, which is a Wednesday, we have to recognize the accrual because the year is ending, the month is ending. So we have to make sure that whatever time happens during that month, we have to make the adjusting entry. The reason why we do this is because we need to ensure that we properly allocate the actual wages earned or consumed during that month. If that month ends on a Wednesday, so be it. You have to adjust for that time. So if they make $70 a day, they worked Monday, Tuesday, Wednesday, that's $210. So we make an adjusting entry for the $210 to get that $210 into the month of December. Then the rest of the time, the 2 days, would go into January's. The adjusting entry increases the liability, which is salaries payable, and also increases salary expense. So I'll show you the journal entry. We debit salaries expense, or also known as wage expenses, and we credit salaries or wages payable. This is the adjusting entry we make December 31. And this is what it looks like on our balance sheet. We increased our liability, salaries payable, and we increased our equity account, which is the expense. Oh, I'm sorry, on the balance sheet. Yeah, just a fun example. There's so many different ones. Okay, let's see. Future payment. So we accrued the wages. Eventually, we need to pay our employee. So we pay them on January 9th. They accrued that. Remember, they accrued that $210 for December 31. On January 9th, we're going to pay them. So we pay them the 210 plus what they earned after that for that 2 weeks, period. We debit salaries payable, debit salaries expense, and we credit cash. Accrued revenues. These are revenues that are earned in a period that are both unrecorded and not yet received. Accrued revenues. Think of this as like, let me think, a dentist. Okay, a dentist or a lawyer or an accountant. You use the service, but they have not yet billed you. Okay, they've not yet billed you for the service you used. Dentists, um, accountants, lawyers, you use the service, they have not yet billed you. That's when we would use accrued service revenues. So a customer made an agreement to pay $2,700 on January 10th for services rendered over the next few days. On December 31, we make an adjusting entry because, again, we need to recognize the revenue or the potential revenue when it's incurred, according to the matching principle. So 20 days worth in December, which is 1,800. It's the total amount times 20 over 30 to represent the 20 days in the month of December. The adjusting entries increase receivables, and the entry looks like this. Debit account receivable to increase our accounts receivable, and we credit revenue to recognize the revenue that is earned. Remember, it's earned when the goods or the services have been delivered. We provided the consulting service, therefore it's earned. And it shows you the relationship between the balance sheet and income statement. And then, of course, our customer's going to pay us more later on. So we recognize the 1,800 December 31, and then we'll receive more in January. Looks like 2,700 in cash. So we debit cash, credit the accounts receivable that was accrued, and we credit the remaining amount of revenue. Everything's linked. The income statement, balance sheet, statement of cash flows are all linked together. We talked about that last week, how they're linked together, but it's important that you also understand that the deferrals and accruals are also linked to those financial statements, income statement, balance sheet. This kind of a summary shows you what the effects are. Now, usually at the end of the year, we prepare what's called an adjusted trial balance. Because we've been making adjusting entries throughout the year, right? And we need to make sure that our balances balance. Our debits equal our credits. We have to make sure that those things balance out. And the way we do that is by performing what's called an adjusted trial balance. We take the unadjusted balances throughout the year, and then we add or subtract our adjusting entries that we made throughout the year, which will give us our adjusted balances at the end of the year. That's what these three categories represent. Don't worry too much about this. I'm not going to drive you nuts with making something like this because it gets complicated and time consuming. And of course, at the end of the year or at the end of the period, we make our financial statements. Prepare the income statement, prepare the statement of owner's equity, prepare the balance sheet, prepare the statement of cash flows. And just like what I showed you last week, all of these statements are tied together. Yeah. So the income statement amounts come from some the adjustments to revenue, some adjustments to the expenses for things like depreciation, which tie all into net income on our balance sheet. I'm sorry, on our owner's equity. Investments plus the additional net income minus any withdrawals gives us our ending balance of equity for the capital. Goes into our balance sheet, and we also see how some of the other adjustments affect other items on our balance sheet. You see, it's all tied together. And that's what you'll see about accounting. It's all tied together. So, as always, there's a couple of formulas you need to understand. This one's really important. It's called the profit margin. Yes, you got to know the profit margin of the company. So important, right? You got to know whether you're making a profit, how much profit you're making off of every dollar sold. The profit margin tells us this. We take the net income divided by net sales, or net income divided by total revenue, whichever it says, right? So net income divided by total revenue gives us our profit margin. Profit margin, real important formula. Of course, the higher, the better. Yeah. These are alternative methods. The alternative methods for recording the adjusting entries. We're not going to have you worry too much about this stuff. It's good to know, right? That's kind of showing you the comparison between cash and accrual based. Yeah, I'm not going to spend too much time on that part. Okay, made it to the end of chapter 3. It's 12:40. I'm going to go ahead and stop this part of the recording. We'll take a 5-minute break, and then we'll finish up today's lecture with chapter 4. So stand by.